Chinese stocks fell by more than 4% on Friday after Beijing revealed that exports had fallen to their lowest levels in 3 years. The 21% slide coincides with the Chinese New Year holiday. It was driven by the trade war with the US and slowing global economies. David Dollar was the Treasury's Economic Emissary to China, joins me now. When this very sharp fall-off in exports, at the same time as the US, of course, had some very bad trade numbers too. But what do you believe is driving the China's numbers?
Well, February is always a weak month in China. It's either the New Year festival or sometimes it comes right after the New Year festival. February numbers we have to be a little bit careful about. But this really caught most observers by surprise. As you said, Richard, exports were down 21%, and that's February on February, so you're comparing two Februaries. That's a lot more than anybody expected. I was also disturbed that their imports fell by 5%. That's usually a pretty good indication of what's happening with domestic demand. That's important for a lot of countries around the world that are selling to China. So those were bad trade numbers, and as you said, Shanghai market fell 4.4%. It also didn't help. There was an interview with the U.S. ambassador to China, Terry Branstad, and he pointed out the obvious, that the two sides are still pretty far apart for a trade agreement. There's no concrete planning for a summit meeting at Mar-a-Lago, and that, I think, also affected the market.
Is it your gut that China's in deep trouble? The government has already, a couple of months ago, it played around with bank reserve limits. It's now done some other financial finaglings to try and give a stimulus to the economy. Is China in trouble?
My gut is that they're not in trouble in the sense of the proverbial hard landing. You know, they've rolled out some modest stimulus measures. They're going to increase their fiscal deficit a little bit additional borrowing by local governments, but it's all rather modest. And I think they have pretty good information about what's happening. If they were alarmed, they would be coming in much more strongly with measures, but they're coming in with modest stimulus. So I think they're probably going to be okay. And if I'm wrong about that and things slide more in the next couple of months, they'll come in with further stimulus. So pretty safe bet they're going to get to their 6% target for the year.
You heard Diane Swang just a moment ago. If you take the US situation on the trade numbers, the US having the worst deficit in some years when it should have been getting better. The US dollar remains extremely strong, which of course is a negative on the imports. And if you look at that trading relationship between the US and China, there's no evidence that it's improving.
Right. I mean, you're absolutely right about that. Last year, U.S. imports from China went up $34 billion despite the trade war. Our exports to China actually went down for the first time in many years. Now, I would say you wouldn't normally expect a trade war to improve the U.S. trade balance, because what the U.S. is doing reduces imports, but it also reduces exports. And so no presumption that it's going to help the trade balance.